What lessons can we learn from notable IPO failures? Imagine investing in a shiny new company only to see its stock plummet after the initial surge. That's what happens when IPOs do not perform as expected. Initial public offerings are a way for companies to raise money by selling shares to the public for the first time. They can be exciting but also risky. When IPOs fail or underperform, they teach us important lessons about the stock market. One key lesson is that market timing and investor sentiment are very important. Even a strong company can struggle if it goes public during a bad economic period or when investors are cautious. For example, during a market downturn or after a big crash, IPO stocks often don't do well. Traders should watch broader market trends and sentiment indicators before jumping into IPO stocks. Another lesson is that hype and overvaluation can lead to sharp declines. Sometimes, companies are pushed into an IPO because of excitement or media buzz. But if the company's actual performance does not meet those high expectations, the stock price can fall quickly. Investors who buy at the peak might face losses. Options traders can use strategies like protective puts or spreads to protect themselves from sudden drops in value. Governance and operational readiness also matter. Companies with weak management, poor risk controls, or not enough regulatory compliance often face trouble after going public. This can cause stock prices to become volatile and shake investor confidence. Traders should look into how well a company is run before investing or trading its stock. Liquidity is another important factor. Smaller IPOs often have less trading volume, making it harder to buy or sell shares without affecting the price. This can lead to wider spreads and higher costs for options traders. Less liquidity means more risk, so it's wise to be cautious with these stocks. Some companies choose different routes like direct listings or special purpose acquisition companies instead of traditional IPOs. These options can change how the stock behaves once it starts trading. For traders, understanding these differences helps in planning strategies. Investor behavior also influences IPO performance. Sometimes, big institutions or retail investors buy into hype, pushing prices higher temporarily. Recognizing these patterns can help traders anticipate swings and adjust their options positions accordingly. For practical trading, it's smart to use options to hedge against IPO volatility. Buying puts or setting up collars can protect your investments. Also, avoid chasing stocks just because they are new or popular. Always analyze the company's fundamentals and governance. Remember to consider liquidity and market sentiment before making moves. In the end, lessons from IPO failures show us that success depends on careful evaluation of timing, valuation, management, liquidity, and investor mood. Relying solely on hype or short-term momentum can lead to trouble. Staying informed and cautious helps you make smarter trading decisions in the stock market.